Hey everyone, and welcome back to another video for today. So you might be asking yourself, how is it possible? SoFi again, beats across the board, incredible guidance for the short and the medium term as well, and yet the stock is down. Stock is down 3 to 4% or so at the time of making this video. How is that even possible? Well, we're going to answer that question in this video because guess what? It's not the first time that this has happened. We are used to, right? It's not the first time like the meme. No, we are used to it. Beats across the board, stock is down, and then a couple of days later, the stock recovers. Now, today specifically, we did have some external news, had a PPI report that came in a bit hotter than expected. We're going to go over that later in the video and also talk about the upcoming new Fed chair, why people say this is bearish for the market, why others will say that it's incorrect. So we're going to talk about all of that later in the video. Let's start and focus on SoFi, and actually I'll show you that it's not just SoFi that's red today. As you can see right here, if we look at the fintech names, the only ones that are green barely is Shift4 is actually green today, surprisingly enough. Hood is up 2.2% and Chime is also up 2.2%. So people will say, oh, the anti-SoFi names are up, but then again, okay, whatever. Neoclouds are all red today. Semiconductor names, it's 50-50. We did have some news regarding NVIDIA, DeepSeek, China. Positive news. Maybe that's why AMD is down a little bit right now. But remember, AMD will report their quarterly figures next week. Then as for big tech names, Meta is down 2.2%. Okay. Apple is down 1%. They reported yesterday after the market closed. I think it was an okay report. Tesla is up 5% today. I don't know why. I haven't seen anything yet. And as for the rest, it's green to flat-ish. Then if we look at the big list here, you can clearly see that there are way more red names than there are green today. It has more to do with a macro than with company-specific issues. And so let's dive right into this. You know what to do. Hit all the buttons. Stay calm, right? It's not going to $75 or $100 or the S&P inclusion anytime soon. Calm down. Have some realistic expectations, and I can promise you that you won't really be disappointed that much. Because at the end of the day, what's the most important? The most important is that we have stocks of companies that are performing very well. If the market wants to punish that specific stock in the short run, okay, so be it. You will have the opportunities to accumulate more and more shares. Now, for those that don't have enough cash or whatever, okay, fine. Doesn't matter. As long as you're holding a company that is performing well, you should be fine because eventually the price will go up. This is something that we've seen before, right? Look at this. This period right here sucked, right? It sucked. Okay, we came off a pandemic period, but still, this period sucked because we knew this is a company that is beating across the board each and every quarter. But look at what happened eventually. If you were accumulating under 10, around 10, you would have been doing very, very well. It's up 300% or so since what, $6, $7. You've had time to accumulate a lot. You still have time to accumulate a lot because I don't think that $30 billion in market cap is the end for SoFi, especially not when you're going to see the expected growth ahead. So calm down, no need to overreact. Everything will be fine as long as the company that you're owning in your portfolios is executing. And so with that said, let's start with the predictions. These were my predictions going into Q4, and I'm happy to say that, again, beats across the board for my predictions. And these were the results. New members, just over 1 million. Acquisition cost, $303, so a bit lower than what I was expecting. Galileo revenue, a bit higher, 122.3 million. Adjusted revenue, as you can see, I was 990 million, closer to $1 billion, and here we got just above $1 billion. Adjusted EBITDA then is a bit higher here, $317.5 million. EPS 13 cents, net income $173.5 million. So I am very, very happy with that performance. And of course, again, records across the board. Record adjusted net revenue, adjusted EBITDA, fee-based revenue, member growth, product growth as well. Now, remember, these were the 2026 targets that were given to us Q4 2023. GAAP earnings per share, 55 cents to 80 cents for this fiscal year. Okay, they also told us in the last analyst conference that the low end is the target because of the investments being made. Then, also, 2023 Q4, they told us sustained compound annual EPS growth rate of 20 to 25%, 26 and onwards. Well, you'll see in the guidance given that, well, the upcoming years are going to be very, very interesting. All right, moving on to the specific segments here. Financial services revenue increased 78% year over year, quite close to the 80% expected here. We see lending revenue up 19.36%, also very close to the 20% expected. And then 15% was what I was expecting for the tech platform, but that actually increased 19%. We did have the Chime impact that also impacted the total account that dropped 23% or so year over year. But we did also get some positive guidance for 2026 regarding that specific business segment. So all in all, this is what we're getting. I mean, that financial services segment thing is really a beautiful thing to see. As for the non-interest income for this segment, here as well, you can clearly see this explosive growth here for financial services. As you know, financial services, that's where the loan platform business is coming under. They also said that, I believe that they've signed or very close to sign a new client for the loan platform business. Maybe we'll get an announcement next week, maybe not, a press release, I don't know. But that thing continues to grow and grow quite rapidly. As for the member growth, you can see they've added just over 1 million members. They are also expecting that to grow quite rapidly this year. And of course, the base continues to be bigger and bigger. So the growth rates naturally will decelerate a little bit. Maybe not, who knows? But it's still very, very impressive. As for total lending origination volume, that also the growth rates are coming down a little bit, but you can clearly see that the same quarter last year was a very, very good quarter, 66.1% year over year growth. And then, yes, that did come down. So the year over year comparisons should be a bit easier, but the trend here is still the same, up and to the right. As for total products, we've seen an acceleration in growth for this quarter. So that's also great. And then they said that the cross-buy increased for the 5th consecutive quarter. Cross-buy reached 40%, that's 7 points higher than the year-ago quarter, demonstrating the power of our one-stop shop model. We've also seen that the revenue per financial services product reached $104 annually, that's up 29%, but that is flat quarter over quarter. Unaided brand awareness reached a record 9.6%, which is up a little bit here. Remember, when they started, this whole thing was just 2% or so. They really want to reach 20%. So there still is a long, long way to go. As for SoFi Money, that increased 33% product-wise. Invest 28%, credit card 56%, referred loans 76%, Relay up 44%, SoFi at Work is up 43%, and crypto didn't even have a full quarter. I think it had a week, 10 days tops, and it's already at 63,441. So all in all, total financial services product increased 38% year over year. Excellent, excellent stuff. And then this whole strategy, right, of becoming a more asset-light business, right, fee-based revenue, it's very high margin, lower risk. You can clearly see what is happening here when you look at the revenue mix. Fee-based revenue is taking more and more shares. That's exactly what you want to see. Moving on to guidance, we got full year 2026 guidance. Yeah, this is the start of the year, so they are starting off, in my opinion, quite conservative yet again, but a little bit more aggressive than what we're used to. Then we're also getting here Q1 2026 guidance. So as for adjusted net revenue, they are still expecting here 30% year over year growth, 52% adjusted EBITDA growth, 34% margin. Net income is expected to grow 72% year over year with an 18% margin, and EPS at 60 cents. Remember, it's 55 to 80 cents was the guidance. They're saying right now it's going to be 60 cents. That's still an increase of 54% year over year. And as we know, SoFi likes to beat and raise along the way. As for next quarter guidance, they're expecting 35% year over year growth for adjusted revenue, EBITDA 43%, net income to increase 125%, and diluted earnings per share basically doubling year over year. They also gave us, and I was very pleased and surprised that they gave us these numbers, financial services growth for 26, over 40%, lending 23% approximately, and tech platform that's excluding Chime, the impact of it, 20%. So we should be expecting some new and nice contracts to come in, maybe some announcements pretty soon regarding the tech platform. Because 20% year-over-year growth for what we thought would be, I guess, a dead business is not bad at all. Then they gave us some medium-term guidance. So management expects to deliver compounded annual growth in adjusted net revenue of at least, again with the at least 30%, I love it, for 2025 to 2028, but that does not include 2025 growth. Additionally, management expects to deliver compounded annual growth in adjusted earnings per share of 38 to 42% also from 25 to 28. The guidance assumes there are no meaningful changes in the macroeconomic environment and no significant new business launches or acquisitions. With regards to acquisitions, if they ever make one, it's going to be one where they've done their research. They are very, very picky with what they're going to do with the money that has been raised, whether it's acquisition or just acceleration of the business organically. Now, as for that 2028 revenue and EPS, if we just do the quick math here, it's an approximate number of $7.9 billion at least, and EPS $1.02 to $1.12. Do I think they'll beat those numbers? Yes, because they basically said it's at least 30%. Also, looking at the numbers that we're getting right now, we assume, because we don't know, I assume that adjusted net revenue is not going to be 30% growth year over year. Remember, 12 months ago, they told us that they expect members to grow, 28% or so? And that ended up being well above 30% year over year growth. And the outlook here is underpinned by macro assumptions, including 2 Fed rate cuts in 2026, real GDP growth of approximately 2.5%, and an unemployment rate in the range of 4.5 to 5%, which in my opinion is very, very realistic. I also think that member growth is expected to be around 30%. They again talked about the $1 trillion addressable market for prime revolving credit card debt suitable for personal loan refinancing, and a $400 billion student loan market with additional growth potential from new private in-school loan options. If you think that SoFi is not going to continue to grow 30% plus for the foreseeable future, then I don't think you've been paying attention over the last couple of quarters and years. Moving on here, we already have a comment from a William Blair analyst. They say SoFi Technologies easily beat Q4 revenue and EBITDA estimates while guiding 2026 EBITDA well ahead of estimates. SoFi's implied 55% incremental EBITDA margin suggests the company does not have enough investment opportunity to keep profitability down. The analyst encourages investors to buy the stock into the post-earnings rally. The future of banking is SoFi. The firm calls the quarter a blowout and believes the company's accelerating key performance indicators suggest an awareness inflection. The stock is in pre-market. It was up 7%, but now it's down. So even better. Which brings me here to the chart. As you can see, the stock is making its way down to the 200-day moving average, which sits at around $22.70. Is it going to hit it, or is this close enough? Remains to be seen. I mean, a lot of stocks eventually revisit the 200-day moving average. Maybe this is SoFi, and then once this is done, it goes back up. RSI also very, very low, very close to being oversold. This brings me to the last thing here, which is Kevin Warsh, the nominee for the next Fed chair, which, by the way, back in 2017, before Trump chose Jerome Powell, he could have chosen Kevin Warsh as well. So he served as Fed governor from 2006 to 2011. In that period, you, of course, have the financial crisis. And apparently, he has deep Wall Street connections. His mentor is this guy right here, Stanley Druckenmiller, pretty popular. You know who's also quite close with Stanley Druckenmiller? Scott Bessent. Correct. So now you might potentially have Scott Bessent and Kevin Warsh. I think it's a good connection here. Druckenmiller says that Kevin Warsh is not a permanent policy hawk. He said, "I could not think of a single other individual on the planet better equipped, I assume, for this job." Because people have been saying that Warsh is hawkish. But Druckenmiller believes that he's more like a Greenspan, letting the economy grow do its thing. Now, in the short term, it can have a negative effect on the stock market specifically because he wants to get the balance sheet back to normal levels. He's probably going to maybe restart QT, although it didn't really officially 100% end just yet, but we're not going to see QE anytime soon based on what I've been reading. And raising interest rates, I really don't think that we're going to see that either. I mean, if Trump chose him, I don't think he's going to raise rate despite the PPI numbers that we've got this morning. So the headline PPI was 0.5% monthly increase, 0.2 was expected. Core PPI was 0.7% increase monthly versus 0.2 expected. And the annual core was up 3.3% versus 2.9% expected, which of course is hotter than expected. CPI report was fine. PPI report, not much, which again raises the questions about this whole trueflation data that we've been seeing. Unless this is a one-time thing, I guess remains to be seen. And of course, just because Trump nominated this guy doesn't mean that he will be appointed. He has to go through a whole process. The Senate needs to approve it. Plus, you also have the, criminal investigation into Jerome Powell. So that's still ongoing. And I've seen one person that said that as long as that is ongoing, there's not going to be a new Fed chair. So I guess all of this, the PPI report that came in hotter than expected, the Kevin Warsh potential appointment, which for now is seen as hawkish or I guess less dovish than the other potential candidates, is putting pressure on the market right now. I think I've seen silver and gold also down today after that thing has gone up like a crypto coin. So it's more about the macro, less about company-specific issues. And if you're asking when is he going to replace Jerome Powell, that's for May 2026. So we still have time. So all in all, that's about it for me in this video. Just like I said yesterday, I think there are many opportunities in the market. I think the market is going to be volatile. This is something that we've spoken about before the earnings season did start. We do expect some volatility. And when you see volatility, usually you have quite a lot of opportunities as well. But of course, sometimes stocks go down because, well, they didn't perform. You don't have to pick those stocks, of course. But if the business performs and the stock goes down, then I see that as opportunity to add to your position. Or maybe if you wanted to open a position, that's also a possibility. Anyways, that's all I've got for you today. Also, huge congratulations to Novak Djokovic on reaching yet another Australian Open final. Wow, what a game. But we'll talk more about sports in the Sunday portfolio update. Anyways, that's all I've got for you in today's episode. Hope you all have a wonderful weekend. See you all in the next one. Bye-bye.